these companies make hundreds of millions of dollars of profit and they pay no taxes. And it's like, how do I take advantage of that? Like, how do I get into this? I was trying to figure out how to best compound my personal wealth. They purposely make it so you have no time to think about anything else except your job. Welcome back to another episode of STR Like the Best. I'm your host, Michael Chang. It's my great pleasure today to invite Amanda and Matt from Keystone CPA onto the show today. Amanda, Matt, thanks for joining me today.
Yeah, thanks for having us, Michael. Excited to be here.
Yeah.
It's a very interesting time. We have had a lot of interest from what happened in July of this year with the new tax bill, the Big Beautiful Bill, and its implications on real estate investing, specifically short-term rental investing. So that's really the main topic I want to cover today. So folks, if you're listening right now, if you're listening on the live, if you're listening on the podcast, this episode will be very specific to the short-term rental tax loophole, its implications. Amanda and Matt really are, two of the leading lights in this space that really understand how this works. So if you are interested in leveraging this part of the tax code, especially if you earn a high wage as a W-2 professional or a business owner, this is really the episode for you to listen to. And if you have, friends, colleagues that would be interested in the topic, please do share the episode. I think they'll find great value from that. Amanda or Matt, you want to kick us off? Maybe just tell us a little bit about your background and how you built Keystone.
Sure. What I always tell people is that we are CPAs by day and real estate investors by night. So many of our clients, we also invest in real estate. That is one of our main wealth building vehicles. But I am the third generation of real estate investors in my family. So my grandparents started doing real estate when they immigrated to the US. My parents dabbled in it. And I really just wanted to not do real estate, get a corporate job. So became a CPA and worked for one of the big four public accounting firms. I just happened to end up in the real estate group. So my experience from my job was always working with real estate investors and how to use real estate to save on taxes.
And then that's actually where we met. So we are married to each other for full disclosure. But we met at the Big Four accounting firm, and I was working in their private client advisor group, and happened to, a lot of obviously wealthy individuals have real estate. And that's kind of where I got my aha moment. I think I was probably 2 or 3 years into my career, pretty green, obviously, but reviewing an individual's tax return. I think he was probably in his 60s. He was retired. All he had was real estate, but it quickly became obvious this person, this is 25 years ago, was making six figures of cash flow and not paying any taxes. Yeah. And so that's when a kind of light bulb went off, like, hey, there's something here. And so when we kind of decided to start our own firm, it was natural transition to work with real estate investors, because we wanted to take all those tax planning ideas you learn for like big companies, Fortune 500 companies, and apply it to the everyday investor, the small business owners. And that's kind of what we do with Keystone CPA.
I really love that, like democratizing access to these types of tax strategies for regular everyday investors like me, you, and anyone listening to the podcast. I come from a finance background. I was an M&A investment banker at some of the large investment banks here in New York. And, early part of my career, we were doing a ton of work for companies that were migrating over to Ireland and doing what was called a corporate inversion. I mean, this is like, a long time ago. And I was just seeing that. I was like, wow, like these companies make hundreds of millions, billions of dollars of profit and they pay no taxes. And it's like, how do I take advantage of that? Like, how do I get into this? And I don't have lawyers at, $3,000 an hour lawyers, right? So it's like, I was trying to figure out how to best compound my personal wealth. You work in a high-end professional services job, like banking. They purposely make it so you have no time to think about anything else except your job. And then half of it gets taken away in April. I think similarly, my wife and I, as after we got married, we're like, okay, we got to figure something else out, because the road ahead was just like, I don't know, this is not going to get us there in the time frame that we want. And then we fell backwards into Airbnb and social media, and here we are today. So
yeah, it's interesting because I think for you, right, you're someone who comes from investment banking, you kind of understand the money side of it. But for a lot of Americans, we tend to think that taxes is something that just happens to us. The narrative out there, in the media is tax benefits are only for the super wealthy, for the large corporations. And I think for the everyday taxpayer, we kind of internalize that. And so most people I would say are unlike you. They're kind of like, well, I just pay taxes, sort of what it is. I complain about it every April and I just
Yeah.
sort of move on with life. And so that's one of our passions, is in educating people that it is not just something that happens to you. There are things you can do to change your facts and use it to your advantage, rather than having it just erode all your earnings every year.
It's insidious in the way you do, right? Because they just take it from you every 2 weeks and you don't see it. And then, it's this one, line item in this very long form that you like barely understand. And then it just kind of goes through. But if you really actually look at it, it is a bit eye-watering, the amount of money that you and I both live in high cost areas, high state. You guys live in California, I live in New York. The state and local taxes are nothing to sneeze at. I think that's kind of cool, the power of social media, and just that kind of that theme of democratizing access to information. 10 years ago, there was nothing like this. You couldn't even access this type of information. But now, if you're paying attention in the right places, there's actually some really good information out there that you can utilize for yourself, and be able to move the ball forward on your personal tax wealth planning. This is the way, like they don't teach you this in school. It's well educated, quote unquote, but like they never taught me any of this stuff, right? I started finding it on Twitter in 2018 before I started figuring it out. It's like, oh, what is this? What is this OZ thing? What is this depreciation thing? And then a light bulb moment is like, oh, hey, I need to buy property. And then here we are. So, well, I'm going to get to the main topic today, is the STR tax loophole. So I'm going to ask you guys a series of questions, which I've prepared here. And because investment bankers need their slides, and that's how I think. But more importantly, I think these are kind of the common questions that we've gotten from our community about what is it, how does it work? So you guys are the CPAs, I'm just interpreting what you guys are telling me. So I would love to, to hear from the authorities themselves, like what some of these terms mean. So you guys ready?
Yeah.
Let's do it.
So definitionally, what is the short-term rental tax loophole? Why does it exist?
Essentially, if people are investing in short-term rental properties, then they can, and they meet certain requirements, they can use losses created on paper from those rentals, from depreciation, things like that. They can use those losses and deduct them against all other types of income on their return. So it's very unlike a lot of investments in the rental real estate space. It's different than investing in long-term rentals, midterm rentals, things like that.
Yeah. If you invest in other types of rentals, you generally have to be a real estate professional to use losses against W-2, which generally means you have to have more time in real estate than your job. The reason we call it a short-term rental loophole is because this is available for virtually anyone. You can have a W-2 job, you can run a business, you can be a social media influencer, and real estate could be a side hustle. And you can potentially use the losses against all types of income to reduce your overall tax burden.
Perfect lead into the 7 ways of obtaining material participation. But before we get there, can we just get a 30-second on what's the difference between passive and non-passive losses, and why is short-term rentals in a way better than long-term rentals from that tax perspective?
I think the easiest way for people to look at it would be kind of think about it as you're investing in rental real estate, you're investing in a business. The question is it active or is it not? Active meaning, are you in 30,000 foot level? Are you involved in the day-to-day operations of it? So Keystone CPA, we're involved in the day-to-day operations. We're active in that business. If we invest in very hands-off rental real estate that's 20 states away and we don't do anything to collect a check, that's very passive. But the beauty with short-term rentals is it's kind of, the IRS looks at it almost like operating a business. So if you are involved in the day-to-day operations, they're going to treat it separately than the rest of the rental real estate world. And that's where it gives you the ability, if you can strategically create losses on paper with depreciation, it can create big benefits from a tax perspective.
What are the actual qualifications tests? We didn't go through all 7, but maybe just like the 500 hour and then the 100 hour, and then maybe we can just talk about that, just because the other stuff I think is will be less relevant for folks.
Yeah. And I think, again, the reason we care about hours is because when you meet one of the material participation hours requirements, that means your rental losses, right? Depreciation, mortgage interest, management fees, paying your kids, all those can offset not just rental income, but also W-2 and other business income as well. Yes, so there are 7 ways to qualify for material participation. The top 3 that we see about 99.9% of the time, the first one is you have at least 500 hours on your short-term rentals. So that could be, getting the property, staging it, getting it up and running, dealing with guest communications. You can also combine your hours. If you're married, you and a spouse, hours could be combined. If you have multiple STRs, you can combine
Oh,
those as well.
the married question. I love that. I see like one spouse's eyes light up whenever I talk about that. So maybe talk about what it means to be married filed jointly, or maybe I don't know, maybe it could be married filed separately actually. But what does it mean to be married, and how, some of the advantage of that outside of having a loving spouse does that do from a tax perspective?
Yeah, I
Yeah.
mean, we're speaking purely tax perspective here, folks.
Yes, yeah. I mean, I think the benefit. So, for example, if a spouse, married spouse, invest in rental real estate together, if we're talking short-term rentals, you can combine your hours to reach the 500 requirement. Now, alternatively, if you're unmarried, so let's say a boyfriend and girlfriend, or just two partners, two business partners, then unfortunately you cannot combine the hours. There's sort of a little bit of a marriage loophole there, right? If you're
Yep.
married, then you can combine the hours. If you're unmarried, then you're separate people for tax purposes. Then you're not able to combine the hours together.
It's very powerful. I have a funny story, or not funny story, but a very relevant story. One of our mentorship students, Ray and May, who are based out in Brooklyn, they were going to plan to get married next year, and then they're in contract for a property to buy now, and they moved up their legal wedding date. They were just going to do it next year, legal
Yeah.
wedding date to I think next week on the 20th of November, because
Mm-hmm.
you know
So when they actually have the party next summer, they'll have to explain to people why they got legally married 6 months ago. And
No, that's a secret. Nobody knows that kind of
no,
stuff.
they need to
no
know
one
it's
no
for
no one
tax.
Unless
knows.
if
It's
they listen
tax
to the
benefits.
podcast,
Yeah.
they'll hear it.
Well, one day this podcast will be big enough for people will know. But no,
Yeah.
for folks listening, it's a really powerful advantage. If you're married, you and your spouse are both interested in doing this. It's a very powerful tool for you to meet the material participation requirement. So, Amanda, I'm sorry to interrupt you. You had three. You had the 500, which is what me and Liz do, since we have 37 properties and we use the grouping election, which if you could touch on that as well. But why don't we go to the 2 and 3?
Yeah, so if you can't meet 500 hours, another way to qualify for material participation to allow you to free up the losses against, offset W-2 and other income is if you have at least 100 hours and no one else has more time than you. So example might be I have 120 hours dealing with guest communications and all that, and my cleaning folks have 80 hours. My landscaper had 20 hours. I had a contractor who had, 30 hours. None of them had more time than me, then I can also meet material participation. And then the third common one that we typically utilize with clients is that you have more hours than everyone else combined. So in that context, if I just bought an Airbnb, I'm putting into service right now between the last month or so of the year, I spend 80 hours in total. So I'm under that 100 threshold. But if I look at everybody else who were involved in the property, all of them added together was fewer than my hours, then I also qualify for material participation. So that's why we say short-term rental loophole is great. It works for almost anyone because real estate could really be just a side hustle. Like if you're a
Yep.
doctor, you don't have to, stop being a doctor. If you're in investment banking, you don't have to quit your job and still be able to potentially earn those hours with one or a few rental properties.
Yeah, no, the doctors definitely should not quit their jobs. Investment bankers, we're not saving lives, so we're just moving numbers around. So, feel free to leave your jobs and get into real estate. Okay, so I really like the third one because I think that one's a lot less understood about the taxpayer being the majority of the hours out of the entire calendar year. So it really works very well for folks right now that close very late in the calendar year, because then even if they don't hit 100 hours, they can still be represent a majority of the hours and qualify under the material participation rules. I have two technical questions actually that come up a lot for some of my students. Under the 100-hour rule, one spouse does 99 hours, the other spouse does 1 hour. What's the controlling hours from a third party cannot do more than you? Is it that 1 hour to 99 hours?
I mean, I think in that example, I would combine the hours together. So, because if you're filing a joint tax return, then you're considered one taxpayer. So it's looking at 100 hours versus everybody else.
Oh, it's just 100 hours. Okay. That's come up a few times. I didn't know how to answer that. So that's great, Matt. Thank you. So just combine everything into one. Okay.
The one thing just to add to that, when we talk about the hours requirements, right? 500, 100, and no one else has more time than you, or you have more than anyone, than everyone else combined. These are the minimum amounts. And, as we know in real estate, if you're using the short-term rental loophole, we're not saving $1,000 in taxes or $5,000 in taxes, right? Oftentimes it's, 50, 100, a couple 100,000 in taxes. And so what we always encourage people to do is to go beyond what the minimum rules
Yes.
are. So, it's not just getting to 100. If we get to 200, that's even better. If we get to 500, that's even better than that. Because you just don't want to eventually, possibly lose on an audit because I got to exactly 100 hours and I can't prove 30 minutes that I was, dealing with a guest issue or something like that.
Yeah.
So give yourself that buffer.
These are only minimum requirements. So I think that's a great call out. The one other point, this more technical point, is the grouping election. So I think this is where people that don't have, and we have these conversations all the time actually with our clients, where they're asking us for CPA recommendations because their CPAs don't understand short-term rentals or in kind of this technical definition on grouping election. I think that's important as people think about scaling their portfolio. They're like, hey, I need to do pass these tests every single year per property. And I'll say that's not true. You have to do X, Y, and Z. So my lead in for you on what is a grouping election and why is that important for someone that's looking to have multiple short-term rentals and not just have the one?
I think it gives taxpayers a lot of flexibility, to be honest with you. So what it is, if you're just telling the IRS that, hey, for purposes of these material participation rules, I'm grouping all of my short-term rentals together as one activity for looking at this test. Now, on your tax return, you still got different columns for each rental property. They're not put together as one. But you're just telling the IRS, hey, it's one activity for purpose of meeting the test. One of the best reasons to look at doing this is just, let's say you were going to use the 100 hours and more than anyone else test for each property. Well, if you were to get audited, now you got to prove time for every person that worked on every single property you. But if you combine your properties, you can get more than 500 hours. If you got audited, now all you're doing is having to prove your own time. We don't have
Yep.
to think about anyone else's time anymore because now you got over 500 hours as a combined group. So that's a huge benefit from an audit defense perspective. Just makes easier record keeping and tracking, I think, administratively.
And I will say this is something that missed so frequently when we review, when
Yeah.
we work with people all over the US on tax planning. And one of the first things we do is review a tax return. And very frequently we see where, they're using the STR loophole with multiple rentals, but not the grouping election is not there. The issue with that is if you're ever audited, just understand that without the election, the default is you have to meet those hours with respect to every single property. And if you're someone looking to scale into 2, 3, 10 properties or 30 properties, you can imagine it becomes impossible to meet the hours, right?
I think, and from a tax perspective, the other benefit of is you might have, I don't know, maybe you have 10 properties and you're spending all your time on 2 of them. 8 of them you are quote unquote passive in. But if you put these together as one, they can all be treated as active. Now we can do cost segregation studies on more than the 2 properties that you were working on. And basically can convert passive losses to active losses and strategically use it that way as well.
Exactly. And I think this is where a lot of CPAs that other tax professionals that aren't as well versed in this sector of investing or just part of the tax code, it's a simple paragraph in your return. It's not splitting atoms here, but for some reason, it's something that I think a lot of people miss. So thank you for calling that out.
The reason it's missed a lot is because it's a paragraph. It's not like a form to fill out or a box to check. It's just like something you attach to a return. So if the CPA doesn't understand short-term to loophole or they don't understand real estate, then it's not something that's natural to actually
Exactly.
right.
Just copy and paste. It's just copy and paste. Shout out to all the CPAs out there that do understand this. Makes my life easier as I speak with clients. So let's move on to the kind of common failure points. So a lot of people work. I actually just had a client message me today. Her husband is a very smart podiatrist here in Manhattan and has a thriving practice, and she's kind of office manager, business manager. And they slacked me this morning and said, "Hey, my CPA doesn't understand this. They're really pushing back on it. We need help." There's a lot of fear out there and misinformation for tax preparers out there that see this big deduction. They don't really understand it. Naturally, being more conservative, say, "Hey, I don't understand this. I don't want to put my name on here and trigger the 4-letter word that starts with an A, right? An audit, right? Everyone's scared of an audit." So I'm going to ask this question directly. What is the number one reason why the short-term rental tax loophole fails when it comes to an audit?
It's interesting. I don't, because we haven't really had any clients who failed an audit on an STR. I can tell you an experience of STR
Sure.
audits. We talk a lot about the different rules and what you need to do to earn the hours. The reality is auditors audit all types of tax returns, so we cannot assume they understand the law with respect to STRs or how short-term rentals even work. So we had a client that was audited earlier in 2024, actually, and the
Okay.
auditor came in, automatically disallowed all of the losses because client lived in California, all the properties were Florida and Tennessee. They came in and said, you know what, you're not meeting any hours because there's no way you could manage your properties from afar. And also Airbnb manages all of your properties. So a lot of the audit was even educating the auditor on what does Airbnb do versus what does the property owner do, right? So somewhat of a long audit, but at the end of it, it ended up being a no change audit. Once the auditor understood how things operated and how someone was able to manage remotely. So those are things, we talk about these hours, and sometimes people will ask us like, well, I don't know, maybe I'm doing it, just wink, wink. Let's just say I did it. But the reason to actually do the hours and earn it and document it is for times like that if you're actually audited, you can prove that you did those things.
Thank you for saying that. I think that is one of the biggest pitfalls out there. People would think this is well, if I get the letter or I get the call of the letter, that then I'll put together the paperwork. No. So do not, if you're listening to this, that is like not the way to go. That is the way to a long road of pain and interest and penalties.
And if you are doing it that way for some reason, don't tell the IRS that.
Yeah, they don't like it
that.
when you recreate documents.
Yeah,
really
because no, right? Because it's just a poor set of facts. And I want to hit on this point, but it's really, really important because an audit is not going to happen that next year, generally speaking. My understanding, guys, is 2 to 3, 4 years down the line. So, they're still looking at 22 right now ish. Right. So this is not something that you file and you're like, okay, cool. Yeah, I passed and, move on to the next. Like there's a lag here, especially given the federal budget cuts to the IRS enforcement. Just things are going to take a little slower. You just want to do it the right way because 3 years down the line, you're not going to remember anything. So if you don't have these logs that were done at the time of when you did these activities, you're going to struggle mightily. You and your CPA are going to struggle mightily in defending you in that type of audit. Now, we use an app called Reps Tracker. That's what we use to record our 500 hours. And, we'll take screenshots. We have our calendar. We just make sure that Liz and I do is all recorded. And there's timestamps. We take videos if we're there. So like everything is like a timestamp, a location stamp, so we can prove that like, hey, we actually went here and did stuff. What do you recommend for your clients? Like pen and paper, app, Excel sheet. Like what is there, or maybe what are some best practices? Put it that way.
I think from a best practice perspective, it's what we tell clients is to, hey, you know yourself better than anybody, so pick the method that you know you're going to stick with. So what we don't want to do is start with Excel for 2 months, switch to an app, and then switch to paper, and then go back and forth. Maybe I'm using a calendar 1 month, and then trying to put some hodgepodge together later on. Find the one. If you like using Excel, great, you can use Excel. If you're somewhere who likes software and apps, go for it. I mean, we probably have, I don't know, there's probably clients that still use paper. I don't know if I suggest that, but
what's really interesting, so for our clients, we have a template that they can utilize and modify in Excel format. But Reps Tracker actually was created from our Excel worksheet. So the founder of Reps Tracker is actually a client of ours. And I always share this. She's a Harvard graduated physician. And when we first started working together, she's like, this Excel is sort of short. I really want an app for it. And a couple of months later, she created an app just in her free time.
In her spare time.
Yeah. Lots of, she's working, husband's a physician as well, lots of kids. And she's like, here's an app. What do you think, guys?
Yeah. No, we recommend it for all of our clients too. It's like user. It's just easy to use. It's very
built
intuitive.
for real estate.
Yeah. It's like someone that actually does real estate investing or short-term rental investing, like made an app for us. Yeah. So the other point that I'll note is if you are a short-term rental investor / operator, it's a couple other tools that I use. We have a separate phone number that we utilize for just short-term rentals. So it records all all the time spent on the phone and all the text messages, so that we just literally download that file, and it can show like our number, who we called, the time, all that fun stuff, so that that supports the audit. What we also do is through our property management platform, we have a log of every single message that we're sending out and coming in. So everything is well tracked, so we know. And we can obviously show the that there are 7 days or fewer on average stays. So everything's all well documented in software somewhere, archived into Google Drive. So, and these are the best practices that we share with our clients too. And I'm sure you guys do the same. But there are just like other things that the log is important. But if you can use a little bit of technology to segregate rental activities you're doing, it just makes your case stronger, right? I can say that I have 500 hours here, and then I show my phone log and I have like 20 hours of calls, whatever that number is. Like, it just helps support that.
What we've seen, the more detailed you are, the more organized somebody is, a lot more weight the IRS is going to give to it. It makes that conversation go a lot smoother. It makes, obviously, you as a taxpayer come across as somebody who's obviously doing this because they're very organized, versus somebody who comes in, again, haphazard, like, well, yeah, let me get that back to, just the IRS is going to give a lot more weight to that.
Okay. So there's a people part of it. There's a qualitative part to it.
Auditors are just, regular folks like us, right? And so whenever we represent clients on audits, the plan is to always show up as an A+ student, which is what Matt's talking about, right? We give them everything on a platter. Everything is referenced, color coded. So it's easy for them, right? We point them to the places where they want to see, make their job easier. That really goes a long way. I know not all CPAs feel that way. Some people are like, let's make their life as hard as possible. They got to dig around for stuff. But we've kind of found the opposite. It's kind of like, we've had auditors say this too. Like, we had one of our biggest clients got audited, and it's, multi-year, multi-partnership, thousands of investor stuff deal that we dealt with. And at the end, the auditor said, you know what, everything was so great that I don't want to waste the government's money in digging around for things here and there. So I do think it goes a long way. Like all the stuff you just said, having a separate phone system. We also recommend having a separate email address just for your rental properties. They could always be forwarded to your main one, but just having that record, it's so much easier for you to pull up correspondences on an audit if it's a separate email rather than combing through your personal, work email that's thousands of different things.
That's cool. You kind of put the human element to that too. I think there's this kind of black box that we think of audits, and this is it's an exchange between two people both trying to do their jobs, right? And they're trying to do their jobs too, and probably feel underpaid and overworked like we all do. So making their lives easier, like, definitely not a bad idea. What activities count and what activities do not count towards these hours? And there is a bright dividing line when stuff counts and doesn't count, or at least as I understand it, pertaining to when title changes. So maybe you can talk about that a little bit.
We're talking about material participation. Usually the most general way to define it is hours that impact the day-to-day operations of your short-term rental. So if you're doing something, the question you ask yourself is what I'm doing impactful for the day-to-day operations? And so a lot of the stuff we kind of talked about, right? Getting the property ready, dealing with guest relations, guest correspondence, scheduling cleaning crew, maybe you clean it yourself. All those different things, even comparing prices, right? Pricing strategy with respect to your STR. Those are all generally material participation. What is not eligible that we get asked all the time is deal analysis. So I'm looking for different deals. I'm researching different markets. I'm learning about real estate. Maybe I want to get into it. Maybe I don't. Those are generally hours that do not qualify because they're not really involved with the day-to-day operations of a specific rental property.
Once you get the property under contract and you're doing due diligence to close on that property, that time should count towards material participation. It's the stuff before you get a property under contract, like Amanda mentioned, you're looking at the market, you're looking at 5 different properties in that market, you're trying to decide on which ones to offer on. All that stuff's not going to count as material participation. And then the same token, I think the question we get a lot too is like bookkeeping and doing things like that. Does that count towards it? And that's where it's, if you are involved in the day-to-day operations of your property, then the time you spend on doing the financials and the bookkeeping can count. But if you are very hands-off and you're just getting kind of a property management statement once a month and you're doing your own reconciliations in QuickBooks or some other software, that's not going to count towards material participation. So
that's a really good explanation. It's less kind of definitional, but just like, hey, this is the concept. If it's towards the operation of that property, then at least record it. And then, should someone ask, then you can explain it and then, have that conversation. What I was going to say was, watching YouTube videos on, real estate investing, going to conferences generally don't count.
One of the things that people always ask about is whether driving time counts. I don't know why that comes up a lot all the time. And so what we typically recommend is the driving time will be associated with the purpose of the drive. So if my STR is in the mountains or, far away from me, and I'm driving there to work on the properties, doing material participation stuff, then generally we recommend you consider those as eligible. If I am driving to a real estate conference to learn about different things, then generally that time doesn't count. So we try to associate the driving with what is the ultimate activity you're doing once you arrive.
So I have a lot of clients in California, New York that have to drive to the airport and fly and get to their property. Does that count when you leave your house to go get to JFK? And
presumably you're flying to your property to work on it, right? Yeah. If you're flying to look for property, yeah, exactly.
No, like post close, you're flying out there to go and do a bunch of work on your property, get it up and running. Mm-hmm. Counts?
Yeah.
All right, cool, perfect. We should make this a game. Well, make this a game show maybe in the future if this gets good traction. Like,
does this count or not?
Yeah,
I'll take this exactly. For 500.
Exactly. Yeah, I know. That would be fun.
STR Jeopardy.
Not be many people that want to watch it, but the people that watch it really, really care about short-term rental tax loophole.
Liz is in the background right now, like trademarking things as we speak. So.
all the people watching on LinkedIn and YouTube, guys, if you like that concept, leave a comment and we'll have Matt.
But it was our idea. Don't steal it.
Let us know who you want to see too. Who you want the contestants to be.
No.
Oh, that'd be fun. That'd be kind of fun actually. It'd be like such a nerdy like real estate like niche content.
Like line up 4 CPAs,
Exactly. Oh, that would actually be really fun. That'd be really, really fun. All right, Erica, well, let's keep moving on. You hit on this a little bit, but maybe just directly, like, what are some red flags that the IRS will look for?
Yeah, I mean, for hours and stuff, the big things they look at is things that just seem outrageous or unreasonable. So I'll give you an example. My client who got audited on the STR that was out of state, there was an entry for 3 hours and the description said salt, pink Himalayan salt or something. And so the auditor picked up on that one and said, okay, this outrageous. Why, what was going on with that? So, obviously it was a matter of, they were in the Smokies, so they had to, drive to the grocery store, get all the supplies, stock up the property with all the supplies. Salt happened to be the first thing on the receipt. So whatever automation they were using, it just carried over the word salt. So all we had to do is basically show actually the actual receipt of all the different things that was purchased. So in hindsight, right, to preemptively avoid things like that, be as descriptive as possible in your time log. So avoid things like 3 hours salt as the description and make it more like, hey, stocking up the STR.
The other takeaway too was that we had to educate the auditor on what that salt meant. They thought it was salt for your kitchen, but it was actually salt for the driveway to get rid of the snow, obviously. So that was a learning perspective as well.
Hey, before I bought my property in Smokies, I did not understand. I learned a lot, and salting your driveway, salting your walkway from your driveway to your house is critically important, especially if you want to keep your insurance premiums low. So, what type of short-term rental purchases generally create the largest tax benefits? If you're thinking about, what's depreciable, what's not, maybe you can frame some of your answers around that.
Yeah, I mean, short-term rentals and just real estate in general, the ones that will give you the highest potential tax benefit through depreciation are properties where land value is lower. The reason for that is because we cannot depreciate land. So if we're looking at a property, let's say it's a $500,000 rental property, if it's in the mountains where land value is 20% of purchase price, then our depreciation calculation is 80%, which would be attributable to the building. But if we took another $500,000 rental that was beachfront, where now 80%
Where's
of the
that?
purchase price was
land. Can you tell me where that is? Because I want to buy that. Yeah. I don't care about depreciation. I want $500,000.
In Panama.
It's in Jamaica. It was worth more than $500 a couple weeks ago, but
yeah.
Fair.
And so in that context, if same 500,000 purchase price, but now I'm only being able to depreciate 20%, right, a starting point for the building purchase. So something to keep in mind. Now, we never recommend buying a property with the tax benefit being the main, right? If you find a great
Exactly.
property on the beach, undervalued, great cash flow and appreciation, by all means do it. But if we're talking the same property, similar expectations, then lower land value is going to get you a better tax savings.
I mean, we like the last house we bought, 195,000. The land was like 61,000. This is in
Nice.
upstate New York. Yeah, yeah, no, we like mountain markets, and so it's tell
Yeah.
that house on the beach is great, but if you're buying a house in 30A that's a block out from the beach, that land value is going to be pretty darn high. I mean, you guys in Southern California, you buy something along the water in Orange County, like
Yeah.
or those Malibu properties that got sold, right? Like just think about the land value that people are paying for those. So high land value, generally speaking, lower taxable basis equals lower bonus depreciation. Last question is more for fun. You guys have a great social media presence as well. I enjoy watching your content. What's some of the bad advice that we see on Instagram and YouTube?
Well, I mean, so, obviously lots of bad advice in general, but what I will say is when I post a lot about short-term rentals, I inevitably get a lot of people who will chime in, whether they're CPAs or not, who will say that's fraudulent. That I'm probably going to go to jail. And I think there's just a lot of misunderstanding about the short term rental loophole, probably because that's what we call it. We call it a loophole. And a lot
Loophole.
of CPAs, yeah, a lot of CPAs don't understand it. I'll give you for the listener, if you are investing in STRs, short-term rentals, and you hear one of these things from your CPAs, these are red flag items that your CPA does not understand how the short-term rental loophole works. One is if they tell you you make too much money to benefit from the STR loophole, that means they don't understand it. They're thinking it's a long-term rental going under the original rule. Or if they tell you you work too much at your job to qualify for the short-term rental loophole, another red warning sign, because like we talked about, we don't care how many hours you work at your job. All we care about is how many hours you're spending on the short-term rental. So those are two, major things. And then the third one is that they say you can't do it because you're not a real estate professional.
Yeah.
That's also a warning sign because for STR investors, we don't care whether you're a real estate professional. So I think those are the things that are very bad advice I hear a lot on social media, not from a post perspective, but just from commenting perspective.
Yeah, no, thank you. That's a better response than what my question was trying to lead you to. No, I think that's great because we hear that all the time. Where it's like, oh, my CPA says I make too much money. Oh, is there a cap? I can only buy one per year. All those things. I'm like, hey, we need to pause for a moment, and you got to think about who's preparing your taxes and giving you tax advice because it's just incorrect. It's fundamentally incorrect, and I think that's where you guys really, and thank you for answering the questions. You guys really serve a great, need in the market. This is still relatively new. Obviously, and we've always had bonus depreciation, but I think this is much more meaningful this calendar year, 2025, because it was 40% before July 4th when the new tax rules passed, and now it's 40%, July 1st, and it was going to sunset to 20 and 0. Right. So it was all going to go away. Now, this is much more meaningful because now it's back to 100%. So 2.5 times the potential benefit. And it's now a permanent feature of the tax code. So there's no sunsetting. It's not going away. Not to say it's going to last forever. Right. It just means that it's not scheduled to sunset. Rules can always change. But there's this really nice window now where if you are making substantial income in your job and you have very little, you don't want to invest in an oil well, for example, you have very limited options on how to legally reduce / defer your tax burden. This is just a great, great opportunity. Now, the necessary conditions are, right, I think to your point, not letting the tax tail wag the dog. What I mean by that is, what you said, Amanda, you're not buying real estate just for the tax benefits, but it's actually a high quality piece of property that's going to be able to generate cash flow for you, at least pay for itself. That's really the most important part. And that's where, for us, we thought there was a need in a market to help people find those high quality properties and help them operate it at a high level so that it's not a negative cash burden for them, right? That it's something that they can hold for a long period of time. It can accrue value to them because this is a deferral strategy. If you sell it, if you don't 1031 it, then, you're going to pay it all back and depreciation recapture is a very nasty, mechanism for the IRS to kind of penalize you for doing that. So really, for this to work, like you have to buy a high quality property that you can hold for a very long period of time. If you don't do that, then I would say this becomes a much less optimal strategy.
Yeah, I mean, speaking of bad advice on social, I think one thing is people talk a lot about buying things for write-offs, right? Buy a car to write it off, buy a jet to write it off. But what I love about real estate is, now we're actually buying an asset that's not, yes, the write-offs, but also just the potential cash flow and appreciation as a result of that too.
That
Yeah.
G-Wagon is not going to appreciate. Sorry.
Yeah.
Generally speaking, that G-Wagon, I think everyone, we're this time of year now where everyone's trying to hit the 6,000 pounds and do all that fun stuff. Cars are great, and some cars appreciate if you have the right car and the right Ferrari, but generally speaking, it's a depreciable asset. And it's not going to cash flow for you unless you're going to put your $220,000 car on Turo, right? Like,
Yeah.
it's gonna, yeah. So, just want to be mindful of why real estate have some really specific advantages. Look, I mean, like you guys are, again, kind of what I was saying to start the show, really the two leading lights in the space. And, as folks kind of go through their individual process and, they are seeking tax advice that's maybe more tailored to their situation, for short-term rentals, maybe real estate more broadly. Maybe just talk a little bit about Keystone, the services you offer, and what's the best way to reach out to you and Matt.
Yeah, I mean, we work with real estate investors all over the country, proactive tax planning. So using real estate and other wealth vehicles to help you save on taxes and keep reinvesting that money to build your wealth. So best place to find us is KeystoneCPA.com.
Yeah, if you're looking for daily tax tips, I'm on Instagram as well as YouTube as Amanda Hunt CPA. But yeah, thank you so much for having us.
Follow Amanda's Instagram account. I follow it. It's awesome. I watch it every day. You're on my favorites list. Great content and good tips out there. Look, I mean, I think, again, there's a lot of misinformation out there. So I think for people that actually are like sharing good tips that are actionable and relevant, I think that's it's a great resource. And thank you guys for taking the time this morning to share with the audience. Appreciate it.
Yeah, thanks for having us.
Thanks for having us.